We're diving into Renko trading. Alright guys, buckle up because this next one is next level awesome. One of the cleanest and most visually satisfying chart types out there. If you've ever looked at messy candlesticks and thought, man, this chart looks like spaghetti, then Renko charts are about to become your new best friend. So what's the deal? Unlike regular candlestick charts that create a new candle every few minutes or hours, Renko charts don't care about time at all. Nope, they only care about price movement, real measurable progress. That means a new block only forms when price moves by a specific amount you set, let's say 1%. Every time the price moves 1% up, boom, a green Renko block appears. And every time it drops 1%, bam, a red block forms. It's that simple. You can even adjust the block size in your indicator settings, maybe 0.5% for tighter detail, or 2% if you want the bigger trend picture. That flexibility lets you tune the chart exactly how you like to trade. Now here's where it gets powerful. Renko charts filter out all the market noise, no random wicks, no tiny indecisive candles, just clean directional movement. This makes trends pop out like neon lights in dark. You'll instantly see when the market is shifting up or down without being distracted by short-term volatility. So when you see a series of green Renko blocks, that's your signal that the market's in an uptrend. Buyers are in full control. But if you start spotting a stack of red blocks, watch out. That's the downtrend kicking in hard. But here's the key thing most beginners miss. Renko charts are just a tool. They're not showing you the actual market price in real time. They're simplifying the story. Think of it as a highlight wheel of market movement. Perfect for clarity, but not for precision entries. That's why smart traders use Renko charts to spot major trends and filter false signals, and then switch back to candlesticks to time their entries with pinpoint accuracy. So yeah, if you want your charts to look cleaner, your decisions to be faster, and your trend spotting to feel like watching market x-rays in real time, Renko charts might just become your secret weapon. Moonphase trading. Oh, I go. This next one is going to blow your mind. We're not talking indicators, not Fibonacci, not even price action. We're talking about the moon. Yes, the actual moon in the sky and how its phases might affect the financial market. Sounds crazy, right? But stay with me, because this is one of the wildest concepts in trading, and some traders actually swear by it. It's called Moonphase trading. Here's the idea. The moon doesn't just move the tides. It also affects human emotions and psychology. And since markets are powered by people, full of fear, greed, and excitement, the moon cycle might just influence how traders behave. So how does this work? Simple. During an evening, the market often turns bullish, meaning buyers start taking over, optimism rises, and prices push higher. Think of it like the start of a new emotional wave, full of energy and momentum. Then comes the full moon, and this is where things get spooky. Historically, this phase tends to bring bearish behaviour. People become cautious, emotions peak, and prices start to dip. It's like the market goes from full excitement to sudden exhaustion. Now, is it magic? No, it's psychology. The moon phases are believed to reflect emotional cycles in human behaviour, and since trading is 90% emotion and 10% execution, even small shifts can show up in price action. But here's the truth bomb. Smart traders today don't use the moon as their only signal. They use it as a confirmation tool. For example, if the chart already shows signs of reversal and a full moon is approaching, that might just give them extra confidence to prepare for a move. So yeah, while it might sound wild, even the moon can have a place on your chart. Because in trading, everything from Fibonacci to human emotion to lunar cycles can help you understand the one thing that drives it all. The psychology of the crowd. Gann angles. This tool looks insane, but once you get it, it's like unlocking the matrix of trading. Alright guys, imagine drawing a bunch of perfectly angled lines that spread out like laser beams across your chart. That's what Gann angles do. These lines aren't just for decoration. Nope. Each angle can act as a potential key level, like invisible walls and floors that the market secretly respects. Now here's the cool part. The steeper those lines are, the stronger the trend. It's like watching a rocket launch. If price is moving inside those steep angles, it means the market's got some serious momentum. But if it's moving along the shallow angles, that's your signal the trend is slowing down, like a car running out of fuel before reaching the hilltop. So in short, Gann angles might look complicated at first, but once you master them, it feels like having X-ray vision for the market. You'll see where price wants to go before everyone else does. That's next level trading power. Alright guys, let's talk about one of the most powerful tools in trading, Fibonacci retracements. This thing is like a secret weapon that helps traders spot exactly where the market might pause, reverse, or explode in the opposite direction. It draws these horizontal lines based on Fibonacci numbers. And trust me, these lines are like invisible barriers where price often reacts. Now here's how it works. And I'm going to make this super simple. If the market is bullish, meaning prices are climbing up, you start by finding the swing low, that's your bottom, and the swing high, that's your top point. Then grab the Fibonacci retracement tool and drag it from the low all the way up to the high. Boom, you'll see several lines appear on your chart. Now here's the fun part. You wait for the price to pull back. Basically, it moves a bit in the opposite direction and you watch how it reacts around those lines. One of the most important levels you'll see is the 0.382 Fibonacci level. This level is pure gold. Why? Because it's where price often decides to bounce and continue its uptrend. So if price dips down and touches that level, and you see signs of it turning back up, that could be your perfect buy entry. It's like catching the market right before it launches again. But here's something every smart trader knows. The market doesn't always respect the same level every time. Sometimes it reverses at 0.5, 0.618, or even deeper levels. So don't rely on Fibonacci alone. Combine it with other confirmation signals like candlestick patterns, moving averages, or support and resistance zones to make your entries stronger and way more reliable. We're talking about the Elliott wave theory, and trust me, once you understand this, you'll never look at a price chart the same way again. So here's the deal. Markets don't just move randomly, they move in waves. Literally like the ocean, prices rise and fall in powerful rhythm, and Elliott wave theory says this happens in a pattern of 5 waves up, followed by 3 waves down before the cycle repeats from the opposite direction. Imagine the market is like a crowd cheering at a concert. First, excitement builds, wave 1, then there's a quick pause, wave 2, then the crowd goes crazy, wave 3, the biggest one, then another short break, wave 4, and finally, a last burst of hope before everyone calms down, wave 5. Then comes the after party, the ABC correction. Now, here's the gravy part. If you can spot these waves forming in real time, you can actually predict where the market might go next before it even happens. On your chart, traders label the impulse waves as 1, 2, 3, 4, 5, and the correction waves as A, B, C. This gives you a roadmap of the market's rhythm. But hold up, not every set of moves is a valid Elliott wave. There are some strict rules to make sure what you're seeing actually qualifies. Wave 2 can't drop below where wave 1 started, and it usually retraces to about the 0.618 Fibonacci level. Wave 3 must be the strongest and longest wave. It's where most traders jump in and push the price hard. Wave 4 must stay above the top of wave 1 and usually retraces around the 0.382 Fibonacci level. Now let's put this into action. Take a look at this chart. You can actually see a 1, 2, 3 Elliott wave forming right there. According to the theory, before the next leg, wave 5, takes off, the price often pulls back to that 0.382 Fibonacci zone. That's your potential buy zone. This is where things get exciting because if you can spot that pullback before the rest of the market does, you're not just following the trend, you're riding the wave before it breaks. And that's the power of understanding Elliott waves. It's like seeing the hidden rhythm of the market, where every move, every spike, and every pullback suddenly makes sense. So yeah, while everyone else is guessing, you'll be out here saying, I don't just trade trends, I surf them. Support and resistance. Alright guys, listen up. This concept is one of the most powerful and easiest things you'll ever learn in trading. Support and resistance. Imagine your chart like a battlefield where price keeps fighting against invisible walls. Those walls? They're support and resistance levels. And once you understand how they work, you'll start seeing the market completely differently. So here's the deal. When the price keeps dropping, but then suddenly bounces back up from a certain point, that point is called support. It's like the floor that stops the market from falling further. Traders look at that level and go, all right, this could be a great place to buy. Now flip that around. When the price keeps rising, but then hits a certain level and starts dropping again, that's called resistance. Think of it as the ceiling that blocks price from climbing higher. And that's where traders often look for sell opportunities. But here's where it gets wild. These levels are not random. They're formed based on where traders reacted in the past. It's like history repeating itself in the market. If price respected that level before, there's a high chance it could bounce again when it gets there in the future. That's why smart traders always keep their eyes glued to these zones. And get this, once the price breaks through one of these levels, everything flips. A resistance can suddenly become new support and support can turn into resistance. It's like the market doing a plot twist. So yeah, support and resistance might sound simple, but mastering them, that's how you start trading like a legend. Dynamic support and resistance. This is where things get next level. All right, listen up. You already know about regular support and resistance, those horizontal levels where price tends to bounce. But what if I told you there's a smarter, more flexible version of that? That's right, dynamic support and resistance. And it's like upgrading from a flip phone to the latest iPhone. Here's the deal. Instead of drawing static, boring horizontal lines on your chart, dynamic support and resistance moves along with the market. It adapts, it evolves. It's literally alive with the price action. How? By using indicators like the moving average, one of the most powerful tools in trading. Finding the perfect EMA setting, the foundation of your strategy. Okay traders, listen up, because what I'm about to tell you is one of the biggest secrets to dominating the market. And shockingly, barely anyone talks about it. I'm talking about choosing the perfect EMA setting. Yes, the exponential moving average. Now, if you don't get this part right, your whole strategy could fall apart before you even enter a trade. But if you do get it right, boom, everything clicks. It's the difference between random trades and real, repeatable success. Now, I know EMA might sound a little technical, but here's what it really is. It's just a line on your chart that shows you the direction of the market's momentum. But not just any line. This one's smart. It's smooth. It filters out noise. It lets you see what's really happening beneath the surface. But here's the catch. It only works if you choose the right period for it. That's where most traders mess up. So how do we figure it out? Simple. We test. We observe. We let the chart tell us the truth. Watch how price behaves around different EMA settings. Does it bounce off cleanly? Does it hug the line like it's glued to it? If price respects that EMA like a trampoline or a barrier, congratulations, that's your perfect. That's the setting that aligns with the psychology of the market you're analysing. Let me break it down for you. We test the 20 EMA, then 34, then 50, then 75, then 100. Keep going. 150, 200, one by one. We're not rushing, we're watching, we're learning. Until one EMA starts to stand out, giving clean rejections, consistent reactions, strong signals. In our case study, it was the 100 period EMA. And let me tell you, the price respected that line like royalty. Over and over again, price bounced off it perfectly. That was our confirmation. But here's the twist that most beginners miss. Just because 100 EMA worked on this chart in this time frame doesn't mean it'll work on every chart. Different markets, different behavior, different time frames, different rhythm. That's why there's no such thing as a one-size-fits-all EMA. You've got to customize, you've got to adapt, you've got to be intentional. And here's the bottom line. If you don't test, if you just randomly pick an EMA setting because some random influencer told you to, you're not trading, you're gambling. But if you do test and find the one the market truly respects, you're stepping into the mindset of a professional analyst. And that's how you start winning consistently. So remember, setting your EMA isn't just technical, it's strategic. It's the first building block of a high accuracy trading system. Get this right and everything that comes next becomes easier, clearer, and more profitable. The breakout. Breakouts are where the real fireworks happen in trading. This is that explosive moment when the market goes from calm and quiet to absolute chaos. When the price suddenly erupts in one direction, either shooting up like a rocket or crashing down like a meteor. Picture this. The market's been moving sideways for hours, maybe even days. Nothing's happening. Traders are yawning, checking their phones, sipping coffee. And then out of nowhere, boom! The price blasts out of that tight zone and everyone scrambles to react. That's what we call a breakout, and it's one of the most exciting and profitable moments you can catch if you're ready for it. Now here's the big question. How do you catch a breakout before it actually happens? Simple. You learn to spot the patterns that come right before the explosion. The three heavy hitters you need to know are wedges, triangles, and rectangles. Think of them like pressure cookers. The market keeps tightening, the candles get smaller, and energy builds up like a coiled spring. Traders don't see it, but you do. You're watching, waiting, ready for that breakout moment when the market snaps. Reversal patterns. We're talking about reversal patterns, and if you those want to catch a trend right before it flips, this is where the real magic happens. So here's the deal. A reversal pattern forms when the market says, all right, enough's enough, and completely switches direction. Imagine the price has been crashing for hours, everyone's panicking, and suddenly, out of nowhere, the market slams the brakes and starts rocketing the other way. That's a reversal. Now, here's the exciting part. These reversals don't just happen randomly. They leave clues, and if you know what to look for, you can literally spot them before the big move happens. There are a few classic reversal patterns that every pro trader knows. Double tops, price hits the same high twice and fails to break higher. That's a signal the buyers are running out of steam. Double bottoms, price bounces off the same low 2 times, showing sellers are losing control. Triple tops and bottoms, basically the same idea, but even stronger confirmation that the market is done going that direction. Head and shoulders, one of the most famous reversal setups. When you see it forming, it's like the market is shouting that a big flip is coming. Cup and handle, a smoother, more subtle pattern that looks like a cup forming on your chart before price breaks out into a new trend. These patterns are not just cool shapes, they're the market's language. They tell you what the big money players are planning before they make their next move. Here's the pro tip. Don't just memorize the names. Learn where they appear. A double top forming after a massive uptrend? That's your early warning signal that a reversal could be just around the corner. A head and shoulders pattern forming near a key resistance. That's your cue to start watching for confirmation candles. Once you master reversal patterns, you're no longer reacting, you're anticipating. You're getting in before the crowd, before the panic, before the explosion. So when the rest of the market is confused, you'll be the one saying, I saw that reversal coming a mile away. Candlestick patterns. All right, guys, now it's time to talk about one of the most legendary tools in all of trading history, candlestick patterns. Here's the deal. Every single candlestick on your chart is like a tiny story. It tells you who's winning the battle between buyers and sellers. Each candle shows the open, the close, the high, and the low of that time period. But here's where it gets crazy. When certain candles form specific shapes, they can actually predict what's about to happen next. Let's start with one of the most powerful ones, the engulfing pattern. Imagine this. A small red candle appears, then suddenly a massive green candle shows up and completely engulfs it. That's a signal that buyers just took full control. Momentum is flipping hard to the upside. And if it's the other way around, a huge red candle swallowing a tiny green one, that's sellers stepping in with serious force. Next up, we've got the hammer and the shooting star. A hammer looks like, well, a hammer, a small body with a long wick at the bottom. It means buyers rejected lower prices and slammed the market back up. The shooting star is its evil twin, a long wick on top showing sellers rejected higher prices and pushed everything back down. It's like watching the market say, nope, not today. And then we have the mysterious doji, a candle where the open and close are almost the same. It's like the market took a deep breath and said, I'm not sure where to go next. That's a sign of indecision. Neither buyers nor sellers are in charge yet. Here's what makes candlestick patterns so epic. They're simple, they're visual, and they work everywhere, on Forex, stocks, crypto, even gold. When you start combining them with support and resistance or indicators like RSI or Fibonacci, that's when you start spotting high probability trades before most people even notice what's going on. So the next time you open your chart and see a candle forming, don't just see colours and lines, see the psychology of the market in action. Because once you learn to read candles, it's like having X-ray vision into trader behaviour. Fair value gaps. We're talking about fair value gaps, also known as FVGs, and once you understand this, it's like seeing hidden treasure zones on your chart that most traders completely miss. Here's how it works. Sometimes the market moves so fast with massive buying or selling pressure that it literally skips over price levels. There's no balance, no back and forth, just a huge jump. And that jump creates what's called a fair value gap, a tiny empty space on your chart where the market didn't have time to trade fairly. Picture it like this. The market is a crowd running down the street. Suddenly, everyone sprints in one direction so fast that they leave footprints missing on the ground there. That empty space? That's your fair value gap. Now, spotting it is actually super simple. Just look for a candle with a big strong body, the kind that screams momentum, and then check the space between the previous candle's wick and the next candle's wick. If there's a gap that didn't get filled, boom, you found it. Once you've marked that gap, draw a rectangle over it. Because here's the crazy part, that area now acts like a magnet for price. Why? Because the market loves to fill in inefficiencies. It wants balance. So after blasting away, price often comes back to fill that gap before continuing in its main direction. So when you see a massive bullish move and there's a fair value gap below, keep your eyes locked in. Price might drop back to that zone before launching again, and the same goes for bearish moves. Price could bounce back up to fill the gap before falling even harder. Here's the secret sauce most beginners miss. Fair value gaps aren't just random holes. They're golden opportunities to predict where price might pull back or reverse. The pros use them to plan sniper entries with laser precision. So next time you open your chart and see one of those empty spaces, don't ignore it. That might just be the market's way of leaving breadcrumbs for you to follow. Heikin ashi candles. If you've ever stared at a normal candlestick chart and thought, man, this looks messy, don't worry, because Heikin ashi is here to clean that chaos up. Here's the deal. A Heikin ashi chart looks almost identical to a regular candlestick chart, but under the hood it works completely differently. Instead of showing every tiny tick and flicker of price movement, Heikin ashi smooths things out, removing all that useless noise so you can focus on what really matters. The trend direction. Think of it like this. Regular candles are like listening to a crowd of people all shouting at once. But Heikin ashi is like putting on noise-cancelling headphones and hearing only the leader's voice. You instantly know who's in control, the buyers or the sellers. So here's how it works. When you see a green Heikin ashi candle, it means the market is trending up. Buyers are in charge, momentum is strong, and the trend is healthy. On the other hand, when you see a red Heikin ashi candle, that means sellers are dominating. The price is trending down. Now here's the awesome part. The size of the candle tells you how strong the move is. Big, thick candles, that's a power trend. Either buyers or sellers are going all in. Small candles with wicks on both ends, that's your sign that momentum is fading. A possible reversal might be coming. But here's the catch, the Heikin ashi doesn't show the actual market price. It's a calculated average that gives you a smoother view of what's happening. So while it's incredible for spotting trends early and avoiding fake outs, you still want to check the real price before entering a trade. Pro tip, combine Heikin ashi with moving averages or RSI and you'll instantly filter out bad setups while catching clean trend reversals that most traders completely miss. So yeah, If your charts look noisy and confusing, switch to Heikin ashi. It's like turning your trading vision from 240p to 4K Ultra HD. Once you try it, you'll never want to go back. Alright guys, that's a wrap. But wait, before you click away, I gotta ask, did I miss any insane trading strategies that you personally love? Drop them down in the comments, because I read every single one. Your idea might even end up in the next video. How awesome would that be? And if you learned anything new today, or if this video helped trading finally make sense, do me one tiny favour that makes a massive difference. Smash that like button and hit subscribe right now. It literally takes 2 seconds, but helps this channel grow faster than a breakout on NFP day. Also, don't stop here. If you're serious about leveling up your trading game, go binge watch my other tutorials right after this. Each one's packed with secrets that beginner traders wish they knew sooner. So seriously, thank you so much for watching, for supporting, and for being part of this amazing trading community.